Welcome to a brand new episode of Smart Money. Now, India is witnessing a transformative era marked by a bold government commitment of an additional 110 lakh crores over the next 5 years towards infrastructure development. Against this backdrop, today we will talk about the growth trajectory and, more importantly, domestic capital participation in this growth. How can domestic investors participate in the growing Indian infrastructure story? Simultaneously, the private credit market in India, a dynamic and crucial component of the financial landscape, has been playing a pivotal role in driving economic growth. Private lenders in this sector cater to diverse financing needs of businesses and individuals, especially those who find traditional banking channels less accessible. Today, I have with me Nitin Jain, the CEO of Neo Asset Management, who's doing a lot of work in this space. Nitin, thank you so much for being here in our studios.
Thank you so much for having me.
Okay, and of course, you know, your erstwhile role in Edelweiss, you have a long association with them. Now you've started Neo on your own. Before I ask you about the private credit market, how has your journey been up until now?
No, it's been super awesome. After being in a professional role as a CEO of a wealth and asset management firm, I spent around 18 to 20 years. So 2 decades nearly in the same company. A great journey. But then this bug of being an entrepreneur probably bit me, and in 2021 we seeded this business. It's actually a wealth and asset management business, so I'm the chairman for the wealth and asset management business. Our CEO for asset management business is Hemant Daga, and he's also somebody that I've known for 15-20 years. Good start. Yesterday I must share that we had our first institutional partner coming in as an equity partner, Peak 15. Very, very high quality name, and I'm very grateful to the team to have participated with us. In terms of AUA, we are managing around $3 billion in 2 years. And in terms of our asset management practice, now we have around 3,000 odd crores across our infrastructure strategy and the private credit strategy. Okay,
very interesting, right? You moved from a corporate job to entrepreneurship. So I'm going to have that chat with you separately on another show, because today we have a particular topic at hand, which is investing in the infrastructure, the growing infrastructure piece in India, right? It's gaining a lot of popularity, especially amongst HNI investors. So just you want to lay the groundwork for us. What makes this an asset class to invest into?
Actually, I think it might come as a surprise to a lot of people that globally, you know, the biggest buyers of infrastructure are actually financial institutions, the pension funds, the insurance companies, the endowments. So around 40 to 45% of the global infra assets are owned by any of these asset managers. Whereas when you see that in India, actually most of the institutional players do not participate. So when the roads in Gujarat are being sold, an Australian insurance company or a pension company is coming and buying those assets, which is bizarre. At least I think there should be more participation from the domestic players. But that also means that there's significant gap between demand and supply. So obviously from an infrastructure point of view, they need a lot of capital. A country like India cannot grow without massive investments in infrastructure. And it needs private capital. The government resources can't be enough to, you know, create that kind of infrastructure.
Absolutely.
And so we are actually a channel to provide that capital from the HNIs, UHNIs and other investors, including institutions, sometimes offshore, and channelize this investment into the real assets or infrastructure in India.
Why is it hard to mobilize capital in India towards Indian infrastructure projects while offshore institutions are so interested?
Actually, there are a couple of points I would say. One, I think relatively speaking, we are a young nation in terms of how developed infrastructure is, right? I think if you really go deep, you'll see it has only really taken off in the last 14, 15 years, the infra. Otherwise, it was purely government-led. In the last 15 years, I think a lot of private money has started to play in. And the institutional players like pension funds and insurance companies are still, I don't know what is the reason, but they're very regulated and not really allowed to participate in anything but for fixed income bonds and ETFs. These are alternate assets. If you were to ask me, I think they should be, and at least they should start considering and evaluating these opportunities, because that will be a huge source of capital to boost the infrastructure and the economy of the country.
Okay, so let's go one by one, right? Private sector investment in India. How has the private sector investment in Indian infrastructure evolved, and what role do financial investors play in this context?
Yeah, so I'll give you a little bit of background, okay?
Sure.
So go back to early 2000s when practically I started my career. I think we used to talk so much about infrastructure. And that was the first time I felt this entire golden quadrilateral and all of those things started to be talked about. And government realized we need private capital. So the first model that came up was PPP model, right? Private-public partnership model. And to a certain extent, I think it served its purpose. The capital was available now, suddenly. But you know, for 7, 8, 10 years, a lot of new players came in and started to participate. But after 10, 12 years, there was a lot of pain in the infrastructure space. If you think about all the companies that were in infra, between 2008 to 2014, a lot of people struggled. You know what is the big reason? So it's very simple, but only in hindsight do you understand a few things, right? All these private players were awesome in constructing, in developing the asset. But the land acquisition and the associated risks, that is not the skill of the private operator. That is something that the best positioned player is the government. So government actually in the beginning said, you take over the project, you aggregate the land, we'll facilitate you wherever it is possible, but the risk is yours.
And to be fair, the risks were aplenty, right, at that time, especially with respect to all the land laws, etc.
It is very difficult. Yeah. It is very difficult. And it is not only difficult in India, it is difficult globally. So if you really want to get private participation, I think these kind of risks which government is best suited for should be carried by the government. Actually, now if you think about, so future forward 10 years, 2015 onwards, you are seeing a lot of models where government is carrying these risks. They then transition the risk of construction to the private operators. But private operators were good at construction, but Sonia, not very good at owning the assets. You know, once you have developed the asset, they were still lying on the balance sheets. So that was the second phase where people struggled. And then what happened was eventually we started to get a lot of global financial institutions to take over these assets from the from these private operators who are building these assets. So now I think we have reached a good balance where the government takes the land acquisition risk, private operators come, develop the asset, and a lot of financial institutions and global institutions actually come and take over the asset from the private operators.
Got it. But you know, okay, let's move on to what investors can do, right? Especially retail investors or even institutional investors. What are the options that domestic investors in India have for investing in infrastructure? How do they differ in terms of returns, in terms of liquidity? And I also want to understand what is the minimum ticket size that investors have to make for such investments?
So I would say there are three ways of participating in infrastructure, right? One is you simply buy L&T stock or stocks like that. I mean, people who are benefiting by the infrastructure.
Listed companies.
Listed companies, right? So there's no ticket size per se. You can buy one share, whatever it is worth. So very liquid, but you carry the risk of the market. You're not carrying purely the infrastructure risk. The second, I think this is a very interesting instrument that has taken off well in the last 3-4 years, is InvITs. So these are InvITs which are publicly listed, which buy specific assets. The management team sit actually in the InvIT. So they are not only buyer of assets, but they're also the manager of assets. Okay, and they are distributing few units to the retail shareholders, and whatever is the cash flow coming to the InvIT actually gets transferred to the retail investors.
So these are multiple assets in one InvIT, right?
Absolutely, multiple assets, but typically they'll have a theme. So for example, the Nexus mall REIT, it will typically have all the retail malls. You will go with the IndiGrid, it will largely have transmission assets, and so on and so forth. And there's the third, that is where we come in. So if you think about the InvIT, a lot of economics is actually captured in the journey of aggregating, developing, optimizing, and then flipping it to the InvIT. So the InvIT shareholders get something like 10-11%, whereas the sponsor of InvITs probably end up making 15-16%. So what we are doing is creating a layer here at the AIF level. We aggregate capital from institutions and individuals, and we buy the assets. We create the platform, we create the teams, and then flip it to InvITs and then distribute it in the retail.
How are the numbers in InvITs now? I mean, the investments through the AIF route compared to, say, what it was a year ago?
So actually, most of the AIFs will eventually flip to InvIT.
Okay.
All the InvITs are held by retail individuals. Okay. So there are 2 or 3 funds, I would say, who have actually followed this strategy. One of which was actually seeded by me around 5-6 years back. And the second one is where we have seeded it around a month back.
Okay.
And we have got our first close done at around 700 crores. So.
Okay. So what are the typical returns that investors can expect from, say, infrastructure investments, from InvITs? I'm trying to, compare it to other asset classes, because to be fair, these InvITs, the REITs, etc., the concept has been there for a while.
Right.
But somehow, maybe lack of awareness, lack of education, it hasn't really picked up as an asset class. Why do you think that is?
Yeah. So one, I think the choices are limited. So because it's a new asset class, so I think people are still trying to get more and more familiar with the asset class per se. But actually it is, I am positively surprised by the penetration, by the way, I must say that. Though it's not as liquid as equity and all, but it's still, gaining a lot of popularity. I think from a returns perspective, my sense is in the InvIT structure, you should probably expect anywhere between 10 to 12% IRR. In the AIF structure, because you're coming before the InvIT, you should probably look to make somewhere like 15 to 16 on a hold to maturity basis. And if you get capital appreciation, it can be higher. But the interesting thing is not the returns about InvITs, okay, or AIFs. Think about, I need constant income for 30 years. Okay. What is the instrument that is available? There's none. If you want, okay, I want to put my money in the mutual fund and it will grow to X, Y, Z amount after 5, 10 years, that's fair. But let's say I want monthly income stream. But
this method that you're talking about, it's through the AIF route, which means there's a 1 crore ticket size, right?
That's true.
So that is for ultra HNIs, HNI category. Okay. Any way that InvITs is a good, asset class for even retail investors?
InvITs you can participate with a very small amount. I was talking about AIFs are for the HNIs. In which you can participate with 5,000, 10,000. It's a great instrument for creating cash flow led income for yourself.
Okay, so since you have, we have a very nice, table here. You want to take us through that? There are different categories, and how do InvITs compare to other asset classes?
Yeah, this is actually quite an interesting slide. But just compare the first three lines here: bank FDs, government bonds, AAA, corporate bonds. One, the returns are very, very low, right? Because most of them are in the range of 7 to 8%. And for, let's say, if you're 30% tax, if you're in that bracket of 30% plus, you're probably talking about 4 to 4.5% kind of net return to the investor, which I think is not even beating inflation. Obviously, equity markets, good returns and very tax efficient. But you need to now be used to the volatility of the markets, right?
So what's the difference between listed InvITs and infrastructure assets?
Yeah, so infrastructure assets are the AIFs that we are talking about.
AIFs.
That is the AIFs that we are talking about. Once it becomes listed, obviously the returns come down because now the cost of capital has come down because it is wide participation. That is, so think about this as listed equity and this as private equity. So obviously, if it's an illiquid asset, you demand a higher risk premium and hence the returns are higher.
So you're saying in infrastructure assets in AIFs, the returns are to the tune of 15%, 18%, etc. Post-tax?
No, pre-tax.
Pre-tax returns.
And the tax is slightly more efficient. So you probably get taxed around 20, 25%, not the 30, 35, because there's an element of capital appreciation and there's an element of distribution.
Okay, very interesting. What we'll do is we'll take a short commercial break, but don't go anywhere. We'll be back. We've been talking about InvITs as an asset class. We're also going to talk about other aspects of private credit. More on that coming up in a bit. Stay tuned.